There is a piece of financial advice almost every Australian has heard, from a parent, a bank, or a budgeting app. Pay off your mortgage as fast as you can. Extra repayments, round up the payment, throw the tax refund at the loan. It is treated as the single most responsible thing a homeowner can do with spare cash. Here is the detail that advice quietly skips over. For a specific group of Australian homeowners, doing exactly that, paying down the mortgage aggressively, is by the numbers the more expensive choice. So here is the question worth asking. How can paying off debt faster cost you more than not paying it off as fast? The answer is legal, documented in the Australian Taxation Office's own public guidance and used routinely by financial advisors for a specific category of client, just never mentioned in the advice everyone else receives. Here is what we found. The Australian tax system treats two kinds of debt completely differently. Interest on a loan used to buy your own home, your principal place of residence, is not tax deductible. Interest on a loan used to buy an income-producing investment, like a rental property or shares, is tax deductible. Same bank, same interest rate. Completely different tax treatment, based entirely on what the borrowed money was used to buy. Most homeowners carry almost all of their debt in the non-deductible category, because almost all of it was borrowed to buy the house they live in. A documented strategy exists to change that, not by borrowing more, but by restructuring the same debt that already exists, so that a larger share of it becomes the deductible kind. If the same dollar of debt can be taxed two completely different ways depending on its label, who is actually deciding which label your debt gets? And why does almost nobody know they can choose? To understand the strategy, the mortgage needs to be examined not as a single block of debt, but as something that can be deliberately split. The technique is called debt recycling, and the mechanism works in 3 repeatable steps. Step 1. An extra payment is made onto the non-deductible home loan, reducing the balance. Step 2. That exact amount is redrawn from the loan immediately through a redraw facility or linked investment loan. Step 3. The redrawn funds are used specifically to purchase an income-producing investment, shares, a managed fund, or an investment property. Because the new portion of the loan was used to buy an income-producing asset, the interest on that portion becomes tax-deductible going forward. Here is the part that makes this strategy genuinely strange the first time you see it. Nothing about your total debt changes. You don't borrow a single extra dollar. The bank balance is identical the day before and the day after. The only thing that changes is which portion of an existing loan is legally classified as for the home versus for an investment. And that classification, confirmed in ATO guidance, is what determines whether the interest on that portion can be claimed as a tax deduction. The debt didn't get bigger. It got relabeled. This works because of how the Australian Taxation Office determines deductibility, not by which account the money sits in, but by what the borrowed funds were actually used to purchase, traced and documented at the moment of the transaction. A loan split into 2 sub-accounts inside the same mortgage, one for the home, one for the investment, is a standard product most major Australian lenders already offer, specifically to make this kind of tracing straightforward to document for tax purposes. The homeowner racing to pay off the mortgage is reducing debt. The homeowner using debt recycling is reducing the same debt while simultaneously converting part of it into a tax-deductible structure that builds an investment portfolio at the same time. This has a name in financial planning circles, though you will not find it in any bank's standard home loan brochure. We call it the deductibility divide, the gap between Australians whose debt is structured to generate a tax benefit and Australians whose identical sized debt generates none, based purely on whether anyone ever showed them the technique existed. Once you know what to look for, you will find the deductibility divide in every financial advice fee structure that charges enough to make the strategy worthwhile, in every mortgage broker conversation that never raises it, because brokers are paid on loan volume, not tax outcomes, and in every extra repayments calculator, published by a bank that profits more from a borrower who never restructures the debt at all. If this strategy is legal, documented, and genuinely effective, why does it stay almost entirely inside financial advisor offices instead of becoming common public knowledge? The answer is not a conspiracy. It is a documented gap in who has access to financial advice in the first place. Personal financial advice in Australia is expensive, typically running into the thousands of dollars annually for ongoing advice relationships. And the regulatory and compliance cost of providing that advice has risen substantially since the 2018 Royal Commission into the banking sector tightened advisor obligations. That regulatory tightening was a necessary response to documented misconduct. But one of its side effects, confirmed in subsequent industry reports, was a sharp reduction in the number of financial advisors willing or able to serve clients with smaller asset bases. Because the compliance cost of advising a client with a modest portfolio is roughly the same as advising a client with a large one, making smaller clients commercially unattractive to serve. This is documented in the Financial Services Council's own industry research, which has repeatedly flagged the resulting advice gap, the segment of the population priced out of receiving any professional financial guidance at all, despite holding assets that would clearly benefit from it. The research consistently finds this gap widening, not narrowing, in the years following the regulatory changes. Here's the mechanism in its plainest form. A homeowner with $40,000 in spare equity and a homeowner with $400,000 in spare equity can both legally use debt recycling, but the financial advice required to set it up correctly, getting the loan splits right, choosing investments that match the strategy, keeping records the ATO will accept, costs roughly the same dollar amount for either client. For the larger portfolio, that cost is a rounding error. For the smaller one, it can eat years of the strategy's benefit. The strategy isn't legally restricted to wealthy Australians. It's economically restricted to them by a flat advice cost applied to two very different starting points. We call this the equity recycling loop, a wealth building mechanism that requires existing home equity to begin, professional advice to execute correctly, and produces compounding tax-advantaged investment growth, meaning it structurally rewards Australians who already cleared the deposit and equity stage of home ownership and offers nothing to renters or recent buyers with minimal equity. It does not create the wealth gap on its own. It compounds a wealth gap that already exists by making one more advantage available exclusively to people who already hold an asset. The deductibility divide explains why so few people use this strategy. The equity recycling loop explains why the people who do use it are almost by definition already ahead. If you've ever wondered why your accountant or your parent's financial advisor seemed to know something about mortgages that never made it into the mainstream advice, stay with it, because the next part puts a specific number on what that knowledge gap is worth. Here is what this is actually worth, calculated specifically. On a $500,000 portion of debt successfully converted to deductible investment debt at a marginal tax rate of 37 cents in the dollar, the annual tax saving on the interest alone runs into several $1,000s a year. Money that, left unclaimed, simply continues to be paid as tax rather than redirected into either the loan or an investment. That is not a one-year benefit, modeled over a 15 to 20-year debt recycling timeline. The period most financial planning documentation uses to illustrate the strategy. The combination of the tax saving and the compounding return on the redirected investment produces a total benefit that multiple Australian financial planning firms model in the hundreds of thousands of dollars, calculated in publicly available case studies used for client education. You can see a rough version of this gap by comparing two identical homeowners. One who spent a decade making extra mortgage repayments, and one who spent the same decade debt recycling the same dollar amount instead. The first homeowner has a smaller mortgage and nothing else. The second homeowner has a comparable or smaller mortgage, a tax deduction claimed every year for a decade, and an investment portfolio that has been compounding for 10 years, built from money that, in the first scenario, simply disappeared into loan principal with no tax benefit attached at all. Here's a number that makes this concrete. An Australian on the second highest marginal tax rate who successfully recycles $300,000 of mortgage debt into deductible investment debt can expect to legally reduce their taxable income by an amount that, at that tax bracket, saves several $1,000s in tax every single year the structure remains in place. Run that for a decade and the cumulative tax saving alone, before counting any investment growth, sits well into six figures. That money was never illegal to keep. It just required knowing the structure existed in the first place. Both homeowners did the financially disciplined thing. Both redirected spare cash toward their mortgage. Only one of them knew the structure existed that turns the exact same discipline into two completely different financial outcomes. This mechanism does not exist in isolation from the deposit and leverage layer already documented elsewhere in this series. There is a precondition sitting underneath the equity recycling loop entirely. Enough home equity to recycle in the first place, which circles directly back to the deposit gate. The next investigation maps exactly how much equity a household needs before this strategy becomes mathematically worthwhile at all. So if the strategy is legal, documented, and genuinely transformative for the people who access it, why isn't it taught anywhere most Australians would actually encounter it? None of this is hidden. The Australian Taxation Office publishes specific guidance on the deductibility rules underpinning debt recycling. Financial planning associations publish case studies modelling its long-term value. The mechanism survives not because it is secret, but because no government financial literacy campaign, no high school curriculum, and no bank's standard mortgage paperwork is incentivized to explain a technique that results in a borrower paying down the bank's loan book more slowly while building an investment portfolio somewhere else entirely. Pay off your mortgage as fast as possible is not bad advice. It is incomplete advice, true for a borrower with no other tax-deductible options, and measurably suboptimal for a borrower who has never been told a second option exists. The mortgage industry did not design this gap deliberately, the way a tax policy might be deliberately designed. It is closer to a gap nobody was ever assigned to close, and gaps nobody is assigned to close tend to persist exactly as long as nobody asks who benefits from them staying open. The strategy nobody talks about was never classified. It was simply never anyone's job to mention it to you, and the people whose job it eventually became were the ones already being paid enough to make the conversation worth having. What you have seen today is the deductibility mechanism sitting underneath ordinary mortgage advice, the documented technique that turns identical financial discipline into measurably different outcomes, depending entirely on who happened to explain it to you first. It does not operate alone. Subscribe so the next investigation reaches you before your own next extra mortgage repayment. Because by the time that payment clears, the choice about whether it became tax-deductible debt or just smaller debt will already have been made. Quietly by default, the same way it always is.